SwayamPrabha. Digital India. Educated India.
Hello everyone. In this session, we will be dealing with real estate development finance and we'll be doing its overview. This is part of the course Real Estate Finance and Investment Strategies. Now, first we will talk about the learning objectives which we will try to achieve in this particular class. The fundamental stages of real estate development, that is something we will try to learn, and then key financial considerations at each development phase, components and structures of development pro formas, feasibility analysis technique for development projects, risk assessment methods in development finance, financing strategies and capital structure optimization. Now, first, what is real estate development finance? So, let's first establish a clear definition of real estate development finance. It encompasses the financial planning, structuring, and management of capital required to transform raw land or existing structures into new or improved real estate assets. So, this is fundamentally different from investment finance because we are creating rather than acquiring income producing assets. The complexity and risk levels are substantially higher than traditional real estate investing. Key characteristics distinguish development finance from other real estate activities. High capital intensity means development projects typically require hundreds of crores of investment in major Indian markets. Single residential project commonly requires around 200 to 500 crores, while large commercial or mixed use development can exceed 1000 crores. Especially we are talking about metropolitan cities. Then extended investment timelines span 3 to 7 years from land acquisition to final stabilization, compared to immediate income generation from existing properties. This creates substantial opportunity cost and cash flow challenges throughout the development period. Then significant execution risk include construction delays, cost overrun, regulatory approvals, market changes, and contractor performance issues. Unlike investment properties where major risks are market related, development involves operational and project specific risk that requires active management. Then delayed income realization in India involves multiple government agencies, lengthy timelines, and significant regulatory compliance requirements that affect both cost and schedule. Post-era implementation, these processes have become more structured but remain time-consuming and expensive. So, understanding these characteristics helps explain why development finance requires sophisticated financial planning and substantial risk capital. Then, let's see a comparative analysis. This comparison table highlights fundamental differences between development and investment approaches that affect financial planning and risk management. Asset status represents the core difference. The real estate investment involves existing income producing assets with established performance histories. Real estate development focuses on creation of new assets with no operating history and uncertain performance. Then cash flow patterns differ dramatically. Investment properties typically generate immediate income from existing tenants or quick lease up. Development projects have delayed cash flows until construction completion and tenant placement or sales execution. Then we have risk profile, reflects these different characteristics. Investment risk is lower and more predictable. In real estate development, we have higher risk and it is less predictable, right? And including, in construction, regulatory, market timing and execution risk. Then we have capital commitment, timeline, effect, financing strategies. Investment properties require shorter duration capital with relatively quick stabilization. Development projects require extended development periods of financing with capital tied up for multiple years. Return expectations differ accordingly. Investment properties offer stable current yield with moderate appreciation potential. Development projects offer higher potential return but with greater uncertainty and volatility. Management focus varies substantially. Investment properties emphasize asset management, tenant relation, property maintenance, less optimization, and development projects require intensive project management. We have contract coordination, approval processes, and we have construction oversight and quality control. So these differences require fundamental difference, skill sets, financial structures and risk management approaches. Successful development requires project management expertise, while successful investment emphasizes asset management capabilities. Then we move to Indian development finance context and we'll try to understand the market characteristics. So understanding Indian market specific is crucial for successful development finance. So first let's look at the rapid urbanization driving demand that is there. We have discussed this earlier that there has been lot of urbanization taking place in India and that is driving the demand for real estate. Land scarcity is also a common phenomena in major metropolitan areas. So as there is less and less land available, so going vertical is the only option, and because of that there is lot of development opportunities available in these cities. Then we have complex regulatory environment post-RERA. So post-RERA, the organized players are increasing their market share in comparison to unorganized because of the requirements which are laid down by the RERA Act. So we are looking at that change also. Then growing institutionalization of real estate finance is also happening. More and more institutions are coming in. They are financing this area and they are because when institutionalization happen, there is more streamlining of the processes and more better inspection and all that is expected. So more transparency is gaining, and then emergences of alternative funding sources. So in one of the class we saw that there are many type of alternative funding which is available. So they are also emerging in India now, and we have alternative investment funds which are also coming up in India. So we are seeing all this, and then typical project scale for residential, it may be from 50 to 500 crores depending on the city and micro market you are talking about. Similarly, for commercial it can vary from 100 to 1000 crores, and for mixed use it can vary from 200 to 2000 crores depending on the micro market or the city in which the project is situated. Then we have 6 primary phases of development. So we have to see that what are these phases. So first we have conceptualization and land acquisition. So in that we can see we have pre-development planning. We have then project financing. Then we are looking at construction. So then we are looking at completion and stabilization, and then we are looking at asset management or exit. So let's take these phases one by one and discuss them. So conceptualization and land acquisition involves identifying opportunities, securing development sites, and conducting initial feasibility analysis. This phase typically requires 20 to 30% of total project cost and represents the highest risk with lowest certainty. Then we move to phase 2, which is pre-development planning, including detailed design development, regulatory approvals, and refined financing analysis. Then we have capital requirements, which are moderate at 3 to 5% of project cost, but these investments become sunk cost if project don't proceed. Then we have phase 3, which is of project financing. This is the structure, project financing, and in that the capital stack combining debt and equity sources to fund the construction, right? And financial management will focus on the cash flow coordination and budget control during this extended period. Then we will have completion and stabilization, which involves achieving occupancy certificates, converting construction financing to permanent loans, and executing leases up or sales strategies. So this phase determines the actual return versus the projection. And then we have asset management or exit, involves strategic decisions about long-term ownership versus sale, and we will have exit timing and strategy significantly affect the total returns. So each phase has its distinct financial requirements, risk profile, and decision points. Developer must therefore successfully navigate all 6 phases to achieve target returns. Failure in any single phase can compromise entire project viability. So the sequential nature means later phases depends on successful completion of earlier phases. Financial planning must account for this interdependence and provide adequate contingencies for potential delays or cost overruns. Then we move on to conceptualization and land acquisition. So this is your phase 1. Okay, phase 1 represents the foundation of every development project. The financial decision made here significantly influence project economics and long-term viability. Key financial activity begins with site identification and preliminary analysis. So in this one, developer evaluate multiple potential sites, conducting preliminary feasibility assessment to identify the most promising opportunity. This would require market knowledge, it would require financial analyst capabilities. Then we have land acquisition. So land acquisition or option agreements will represent the larger single capital commitment in development projects, and it will be developer must decide between outright purchase requiring immediate capital deployment versus option agreement that provides more flexibility with lower initial investment. Initial market research and demand assessment that will involve studying competitive properties, absorption rates, and price trends to validate the development assumptions. This analysis informs product mix design decisions and pricing strategies. Then we have preliminary financial feasibility testing. So, using basic pro forma analysis, determine whether projects meet minimum return threshold before proceeding to detailed planning. Then we have financial commitment characteristics, which actually are very challenging. So this phase typically requires 20 to 30% of total project cost, a substantial commitment with limited liability, limited ability to recover investment if the project don't proceed. Then this represents the highest risk phase with the lowest certainty because many variables remain unknown. We have construction cost, approval timeline, and market condition continuously evolving throughout the development. Funding typically comes entirely from development equity because lender won't finance land acquisition without detailed development plans and pre-sales or pre-leasing commitments. So our example demonstrates typical scale. A developer acquiring a 5-acre site in Pune IT corridor for 80 crores, representing 25% of the project, 320 crore total development cost. This substantial early commitment requires strong development financial capacity and confidence in project viability. Success in phase 1 requires balancing aggressive pursuit of good sites with prudent financial risk management to avoid overextending capital commitments. Then we go to phase 2, pre-development planning. So basically the key financial activities in this will be detailed market analysis and demand studies, architectural and engineering design development, government approvals and entitlement processes. We have refined feasibility analysis and pro forma development. Typically, this will cost design and consulting around 2 to 3% of the project cost. Approval and permits will cost 1 to 2% of the project cost. Market studies and due diligence will lead to 0.1 to 1% of the project cost. And the risk here, these investments are largely sunk cost if project does not proceed. Basically, if the project will not go ahead, this will be basically all lost. Then we have phase 3, which is project financing. So in this particular phase represents the critical financing stage where developers structure capital to fund construction and development. Capital structure decisions made here significantly affect project return and risk allocation. So capital stack components typically include 4 primary sources: senior debt, mezzanine, developer equity, investor equity. So senior debt represents 60 to 70% of the financing, provide the lowest cost capital with first priority claim on project assets. Senior lender typically offer construction financing that converts to permanent financing upon project completion. Mezzanine debt comprises 10 to 15% of financing, providing higher cost subordinated financing that fills the gap between senior debt and equity. And mezzanine lenders typically charge 15 to 20% interest and may receive equity participation in project returns. And then we have developer equity, which represents around 10 to 15% of financing. consisting of the developer's own capital contribution. This equity bears the highest risk but receives residual profits after debt service and preferred returns. Investor equity comprises of 10 to 20% of financing from external equity partners, including private equity firms, family offices, or institutional investors. These partners typically receive preferred return and profit sharing. Then key activities here include structuring this optimal debt to equity ratios that maximize return while maintaining acceptable risk level and lender requirements, negotiating loan terms and covenant effects, project flexibility, and developers control during the construction, establishing draw schedules and milestone requirements, align capital deployment with construction progress, finalizing guarantees and security arrangements, determine developer risk exposure and lender protection. Right. So, success in phase 3 requires sophisticated financial modeling, strong lending relationship, and skilled negotiations to optimize capital cost while maintaining operational flexibility. Then we have one construction finance example. So here you can see that this particular luxury residential tower, which is costing around 500 crores, how the breakup of different financing options are from 325 crore for senior bank debt to 75 crore for mezzanine, for 50 crore for developer equity, which is 10%, and 10% for PE partner investment financing. So that is there. That is the overall breakup, which is your blended cost of capital of approximately 14%. So that is there. This kind of stack you will see for such projects. Then for phase 4, we have of construction. So here construction loan will basically draw coordination, involves managing cash flow from lenders based on the construction milestone and budget requirements. We have timing of draw effect cash flow management and interest cost minimization. We have budget monitoring and cost control, requires continuous tracking of actual cost versus budget projection. Early identification of cost overruns enable corrective actions before problem becomes unimaginable. Progress based milestone tracking aligns financial draws with construction completion, and lender typically release funds based on the verified construction progress rather than time-based schedules. And we have draw schedule example shows typical progression of construction financing release. Land and site preparation typically receive 20 to 25% of loan, covering initial site work and foundation preparation. We have foundation work of which represent 10 to 15%, covering excavation, footing and structural foundation element. And then we have superstructure construction, comprises in largest draw at 35 to 50%, and we have building system installation that represent 15 to 20%, and completion will be around of 5 to 10%. Then phase 5 will be completion and stabilization. So obtaining completion and occupancy certificates will be one. Conversion from construction to permanent financing, this will be the sixth stage there. And then lease up or sales executions, that will come now. And achievement of stabilized occupancy, so that we are getting to. And then residential stabilization time will be 6 to 18 months post completion. Commercial, it will take a little longer, from 20 to 24 months for full lease up. And for retail, it will take around 18 to 36 months depending on the tenant mix you are getting for your retail establishment. So that kind of time period will be there. Then we have phase 6 of asset management or exit. So here they can have different strategies. You can hold. So long-term income generation, you can keep holding this. Stale strategy would be you have made it, you capital recovery and profit realization, just sell it and go away. And partial will be you can actually go for some kind of arrangement of ownership. So that will be a partial disposition. Or there can be a REIT InvIT contribution institutional exit mechanism, which is now available in India. So basically what happens is that these REITs, like previously we discussed that there are sponsors. So each REIT has a particular sponsor, a developer company. So what they do is that they transfer their property to REIT mechanism. So that is what we are talking about here, that so Embassy REIT, so Embassy transferred their property to office properties to this REIT, Embassy REIT. So that kind of or Mindspace Raheja group actually transferred. So that is how they transferred their property. So that kind of mechanism is also available to you, that you can transfer your property to REIT mechanism, and then there it becomes public kind of public is also get involved. You have your small investors investing in your company. So that kind of public limited type of systems then gets created. So these are some different type of strategies you can think of, that these are the strategic options which are available with the developer to come out after the development of the project. So that is there. Now what are the financial considerations here? So exit timing, optimization, best time to exit, that you have to optimize, tax implications of different exit strategies. So one of the point which I want to also highlight here, that the REIT, the earlier from 2014 to 2019 on till there was a lot of hindrance from the builder and developer lobby, that why they were not willing to come up with their REITs even after such a long period, because they were still asking for government to give more and more clarity of tax implications. So because of once they got their tax clarity, they started coming. And InvIT is also kind of REIT type of property, but InvIT is basically for infrastructure properties. So it almost follow the same model which is there for the REIT. So there also gradual pickup started after the clarification of income tax. So income tax implications are very much required for this decision, what type of strategy you are adopting. And then market conditions and capital availability. So that is there. What kind of market conditions are available, what are the capital which are available, that kind of situation will be deciding. And then opportunity cost of continued ownership. So you will compare, you will make comparison, and then you will decide on the right strategy. Then components of feasibility analysis. So we will now move to what is there in the feasibility analysis. So we have market analysis. So we will try to gauge what is the gauge the demand and the supply in that area, and the competitive assessment, if there are other projects coming in that area of similar nature, so they will become our competitors. So future, when we have completed our project, we'll be able to sell it, and because there is so much competition and supply will be coming, so will the demand will have the upper hand. So that kind of balance we have to do. For this, we will do proper market analysis and find out what is the situation in the prevailing market. That might be a micro market or the overall local market of that area. So this kind of market analysis will be done in feasibility study. Then site analysis, physical, legal and regulatory evaluation of site will be done. So, whether what is the physical condition of the site, what is the legal status of the site, the papers and everything, who owns the land and everything. And then regulatory, what are the rules regarding the development for whatever projects we are thinking. So the local rules will govern. So what are the regulations regarding that? And then financial feasibility also, we would like to evaluate and understand that what are the return projections we are aiming for, and viability testing we can do to check whether this thing will hold or not. So we will be doing all this in financial feasibility, and each component must support project viability for development to proceed. So all of them, when they are supporting, and when all the things are all on the same page, we are ready to go after only all of them are in the one direction, pointing towards the one direction. Then we have market analysis framework. So here we have demand assessment. So in this we will check what is the population and employment growth trend in that area. So if we have population growth in that area or not, the kind of employment growth, the companies which are there or which are there, and the kind of trends which are visible. So all that will be analyzed in population and employment growth trends. Then the income level. So if we are going for a mall, so what kind of consumers of our mall will be there. So the footfall, the kind of footfall we will be getting. So we will evaluate that, and also understand the purchasing power, because depending on that we can expect the type of tenants we will be getting for our mall. So all this is done in your demand assessment. Then demographic composition, what is the mix of the overall population in that area, and then what are their preferences. So depending on the kind of people are living there, their age group and the kind of work they do. So for example, in Bengaluru, IT workers become important consumers. So that is something which we would like to check. So these are some other things which we will be looking. Then historical absorption rates and the pricing trends, that also something we will definitely look at. So in this what we will be doing is that we will be looking at the baseline expectations for market performance, and help calibrate projections against the actual market experience. Then we will move to supply analysis. So in this we will examine competitive environment and future supply impacts. Existing inventory and occupancy level shows current market balance and unmet demand. Then we have pipeline supply and competitive projects that identify future competition that could affect absorption rates and pricing power. Then we have timing of competitive project delivery that can affect market entry strategies. And we have market share analysis by location and product type that helps position proposed development relative to successful competitive projects. And then we have future supply demand balance projection, estimating market capacity for additional development over the project timeline. So this way we will be looking at the supply analysis also. So successful market analysis requires combined quantitative data analysis with qualitative market knowledge to develop realistic projections that account for market dynamics and competitive response. So that is there. Now this analysis basically informs all subsequent decisions, including product mix, pricing, market strategies and timeline planning. Then let's take this case. So here we can see that we have a catchment population of 350,000 growing 12% annually. So we have a good growth, right? And we have retail spending, which is 9,500 per month per capita. That is decent. And there is a 8% growth in that. Then existing supply of 5.2 lakh square feet, which is there. And so retail, we are talking about retail development, right? So 5.2 lakh square feet and there is a 92% occupied. So the supply is coming and 92% is occupied. So limited available space. So there is still like we can go with this. And then pipeline supply, there is 2.1 lakh square feet under construction. So existing is 5.2 lakh, 2.1 is coming. There is some future competition we can see. And there is existing competition also, even though it is 92% occupied. So there is something which we have to think that 2.1 lakh square feet is coming up just like we are coming. We might be coming with our retail. So we have to plan accordingly that whether we are okay with this or not. Then we have absorption rate, which is of 45,000 square feet quarterly. So supports 1 lakh square feet development. So basically this can, this may help us, that we can also still think of it, that we can bring our project here. So conclusion, market can support proposed development scale, but now it is up to us whether we want to go with it or not. Then we have site analysis components. So in this site analysis components, we have site which we look at, physical attributes of the sites. So we will be looking at the topography, soil condition, environmental factors. We will be looking at existing structures and demolition requirements if there are any. Then we will be also looking at utility availability and infrastructure access. So these are also important because like whether we have electricity or water supply and infrastructure access, there is proper roads and everything directly to our place or not. And then transportation connectivity and accessibility to the project which we are doing. Then legal regulatory framework. So title clearance is there, ownership verification from where we are about to purchase. So all that is clear or not. Then zoning compliance, whether we are allowed or permitted to make what we are thinking of. So for example, if we are thinking of a mall, are we allowed to make that or not? And then FSAI, FAR limitations. So if we are going for multi-story, so what number of floors we can go for. So all that we will check. And then required approvals which are there and estimated timelines we will have to find out if we are approved to make that building in there or not, because sometimes there are some special zones in which special circumstances are there. For example, your funnel zone and a heritage zone, or your maybe near the coastal or something, coastal zone. So there are different type of approvals which might be required, and so we have to check them and decide on the estimated timeline. So this will be part of your site analysis components. Then here we can see the FSI and FAR analysis example from a Gurugram site. So here we can see that our Gurugram site comprises of 1 acre with 2.5 FSI allowance. So that is there. The base FSI of 1.5 provides fundamental development right of 65,340 square feet basic developable area. This represents minimum development potential without bonus FSI component. Then we have TOD, that is transit oriented development, that is there. That premium is available to us of 0.5 FSI adds to 21,780. So that is something which we are getting. So then we also, and basically this TOD is due to the proximity to metro stations or planned transit infrastructure. So TOD bonuses encourage high density development near public transportation. Then we have green premium of 0.5, that is also there, of FSI, provides another 21,780 square feet for meeting environmental sustainability, such as LEED certification or green building requirements. So these bonus incentive wise sustainable development practices. So total permissible FSI is of 2.5, which allows 1,08,900 square feet. So apart from that, there will be some setbacks. So that we have to subtract. So setbacks have to be removed, and this will be the net developable area which we have. So this analysis basically is telling us that how regulatory constraints significantly affect development potential and project economics. Understanding FSI calculation helps developer optimize the utilization and maximum development value with regulatory parameters, right? Then we go to financial feasibility metrics, key performance indicators we will look at. So it includes return on cost, ROC, calculated as net operating income divided by total development cost. This metric shows stabilized property performance relative to development investment. Then we have this helps compare development return with acquisition alternatives. We have IRR, we have timely weighted return calculations. So IRR calculation must include all cash flows from initial land acquisition through final exit. Then we have equity multiple, measures total return relative to equity invested, and basically equity multiple helps evaluate return relative to risk and compare with alternative investment. Then we have payback period. So that indicates time required to recover initial investment through project cash flows. Shorter payback period generally indicate lower risk and faster capital recovery. Then we have NPV, which indicates project return exceeds minimum required returns. And then we have Indian market benchmarks. So we have residential IRR of 20 to 25% reflect high risk and longer development timelines. Commercial of 15 to 18% reflect more predictable tenant demand and professional management requirement, but low risk profile. And then retail target of 16 to 20% reflect the moderate risk level with tenant merchandise mix challenges, but generally strong cash flow once stabilized. So these benchmark guide development decisions and help evaluate whether project returns justify development risk relative to alternative investment opportunities. Then we go to development pro forma components. So here we have land cost, we have hard cost, so purchase price, transfer fees, due diligence. We have hard cost of construction, site preparation, landscaping. Soft cost will be of professional fees, approval, marketing. Financing cost will be your interest fee, loan charges. Contingency will be typically 5 to 10% of hard cost. So that will be your total breakup. And then revenue projection, so sale pricing assumptions and escalations we have to make. Rental rate projections and lease terms projection we have to make. What will be the absorption, lease up timeline, all that we will have to basically project. And then operating expenses that will be there, that when we want to operate, what will be the operation that that we will be facing. So this in commercial development, it will help offset property management cost and maintain net income level. So accurate pro forma development requires detailed cost estimation, realistic revenue projection, and conservative timeline assumptions to ensure project viability under various market scenarios. Then we have development cost breakdown example. So here we can see land cost amounts to 25 crores, which is 25%. We have hard cost 55 crores. So basically all these costs for 200 unit of 2 lakh square feet saleable area. Chennai residential project is there, and that per square feet our total cost is 5,000. So this is the kind of estimation we have to do. So this identify the cost control opportunities and optimize the project return through efficient resource allocation. Then cash flow analysis. So this will initially negative during land acquisition and construction. Of course, you will have to pay. Then gradual improvement as sales leasing progresses. Once it will progresses, the money will start flowing. Positive cash flow typically begin in later construction phases. Peak negative cash flow determine the maximum funding requirement. That will be, of course, at the starting. So critical metrics which will come out, peak funding requirement, basically the starting point, maybe sometimes during the construction, but mostly at the starting. Then when will be the break-even timing, cash flow turning points, and that is from negative to positive, and cumulative return realization. So that will be your cash flow analysis framework. So here we can see that first quarter we lost, then second again we are still losing. This is a residential project example, Navi Mumbai, and then we actually keep on going like this. That is how this thing is happening. And then we have this thing that in quarter 2 to 4 reflect your construction ramp up with cost of 16.5 crores quarterly and steady pre-sales of 6.5 crores. Now it has started. So earlier we were going for this net CF of minus 11 crores, and then we started raising, so resulting in negative 10 crores quarterly. Then Q5 we saw peak funding period with the cost of 12.5 crores and revenue of 8 crores. Now we started getting this, and so creating 4.5 minus 4.5 crore negative cash flow and peak cumulative negative position of 25.5 crore. Then Q6 to Q7 we show improvement as major sale recognizes. The major sale has started recognizing revenue, and the cost of 22.7 is there. But this time revenue is exceeding the cost and we are in the plus. So we are 10.3 crores and reducing cumulative negative position to minus 15.2. So here we were in the peak and then we started coming back. And so in peak funding of in Q5 represent your critical financing requirement that must be adequately structured in project financing. So this is the crucial time that we have to look, and so this is how we saw. So ultimately in the quarter 8 to 10 demonstrates the strong performance where we got 62 as our project revenue, and there we generated 47.7 crores. So we came in plus. So this kind of pattern is showing that typical residential development cycle where early negative cash flows are recovered through sales execution in later construction phases. So successful cash flow management requires conservative funding for peak requirements and effective sale marketing strategies to achieve projected revenue timing. Right? So that is there. Then we go for profitability analysis metrics. So profitability analysis provides comprehensive evaluation of development project return using multiple metrics that capture different aspects of project performance. Development spread calculation compares stabilized NOI to total development cost. Our example shows stabilized NOI of 18 crores and total development of 200 crores, yielding development spread of 9%. Market cap of 8.5% represent return available from acquiring existing stabilized properties. Development spread of 50 basis points above market cap rate indicates the development premium that compensates for development risk and project management efforts. So profit on cost, basically analysis, this overall measure is providing us profit on cost of 5.88%. This profit margin compensates developer for development risk, developer risk, and that is what we are looking at. So equity return, here we are talking about 550 crore and equity IRR of 20.5% and equity multiple of 22.2 times. Then we look at development risk categories. So demand volatility, we have market risk, we have construction risk, and we have financial risk. So demand volatility can be there, pricing pressures, economic cycle which can change, and regulatory changes can take place. We can have cost overruns, schedules can delay, quality control and defect management can be there, and the resource available and labor issues might be there. So these have to be the risk we have to think of. And then interest rate fluctuations can happen for funding availability and lender requirements, that might be an issue, and exit market conditions and liquidity can be challenging. So these things have to be taken care of, proper hedging and everything has to be ensured. Then sensitivity analysis. So in this, testing impact of changes in individual variables. So we can fix one variable and check. So construction cost variable would generally lead to plus minus 5%, plus 10%, plus 15%. So that kind of variation, sale price change might be 5 plus minus 10%. Timeline adjustments can be plus minus 6 months. So that can also be checked. And interest rate movement of plus minus 100 to 200 basis points we have to check. So these are some things we can check using sensitivity analysis. We can also do multi-variable analysis examining combined effect of multiple variable changes. So scenario analysis, then that will be done. So this kind of analysis we can do to check the risk, similar to what we had done earlier for development finance also. So sensitivity and example will be your IRR impact. So here we are talking about variable changes plus 10% construction cost, impact on equity, minus 5 percentage point, plus minus 5% sale price, minus 3.2 percentage point. So that kind of impact we can gauge by taking the adverse conditions, and analyze the impact on our IRR. So we can, so that we can, have a proper understanding of the risk involved in this project, right? So then financing strategy, optimization. So cost of capital, that we have to look, balancing debt. So we have seen combining different type of debt we can do. Risk allocation, appropriate risk sharing with capital provider. Control, who is controlling? So maintaining operational and strategic control. Flexibility, ability to adapt to changing conditions. So we have to keep some of these options open. Then exit options aligned with the planned exit strategy, that when we will exit. And there are certain emerging trends we should be aware of. Green financing, REIT and InvIT we have discussed. Fractional ownership platforms we have in previous class we discussed that co-ownership platforms are coming, so they can also provide good funding opportunities. And joint venture structures with institutional partners, especially the foreign institutional investors, can be good opportunity. So conclusion, thorough market analysis, understanding demand dynamics, realistic financial modeling has to be done, conservative. We have to be very conservative. If we have to err, we have to err on the we should be pleasantly surprised, not the negative surprise. Optimal capital structure, balancing, taking right finance mix, that should be the idea. Proactive risk management, identify and mitigate key risks, do the scenario analysis. So all that will help us. Sensitivity analysis will help us in doing the proper risk management. Executing the excellence, maintaining the schedule and budget discipline will help. And basic professional development, using all these techniques which we have learned in the session, should be very helpful for us. So these should be looked into, and we should be implementing all these strategies properly for the development finance of our project. So the next step will be, recommended action would be to practice all this, whatever we have learned, and these are some additional resources you can go through. Thank you so much.